Hello and welcome to today's webinar, Credit in Focus. We'll take a look at a review of 2025, an outlook for 2026, as well as some banking risks. My name is David Wong. I'm from Fitch Learning based in Hong Kong, and I'm your host for this webinar. And we're very fortunate to have Pramod Shenoy, Head of APAC Research at Credit Sites based in Singapore, with us today. Pramod and I know each other well, of course, as we've been on panel discussions together over the years, invariably discussing credit risk in the APAC region and often focusing on banks. I just at this stage want to encourage all participants to make use of the Q&A button at the bottom of the screen. What we'll try to do is we'll spend around 40 to 45 minutes at the beginning discussing a variety of issues and leaving 15 to 20 minutes at the end for Q&A. Now let's get right to it. It's mid-November, we're almost 11 months in, so many investors and analysts alike are already taking a keen interest in the outlook for 2026. That's something that I'll be asking Pramod to share his insights throughout this webinar. But before we tackle that, Pramod, can I just ask you to highlight the key developments we've seen across Asian debt markets in 2025? And specifically, why you think these developments matter to investors?
Thanks a lot, David. So 2025 has been an interesting year in the Asian debt capital markets space. If one were to take a step back and you were to look at the COVID period, we had a particular period of time where interest rates were really low as governments tried to ensure that there was as much of funding that was available as possible, keep interest rates low, and that's going to be good for the credit environment. What we did see from October 22 onwards is that interest rates started moving up, and as a result of that, base rates and inflation was anything but transitory. We did see rates going up a fair amount, and they've only recently started coming down. So if you are a treasurer in the APAC region, then you have four choices basically on where to raise liquidity from. You can go for a domestic loan, you can go to the domestic bond markets, you can go for international loans, and you can go into the international bond markets. And what treasurers tend to do, David, is that they want to look at the international bond markets when they want size and they want duration. With interest rates high, you don't want to lock in size and duration because that's going to be expensive. So the bond markets were relatively unloved, and you didn't see that much of issuance happening, which led to an interesting technical factor, which is that there were a lot more of redemptions every year than there was fresh issuance. So what that meant is that spreads in the bond markets in Asia, which typically were about, say, in the investment grade market, which were at least 20 to 25 basis points wider than the US investment grade market, spreads in Asia over the last year and a half have been 15 to 20 basis points tighter than the US investment grade market. If you are a global allocator of capital, then you will say, why should I allocate money to Asia at all? It's better to invest it in the US market. So Asia did face a little bit of a challenge of fund flows. But the good news from Asia is that that situation is now gone. Issuance this year is up 25% year on year, which is good. And frankly, credit, the quality of credit in Asia is very good. So you do tend to see international investors saying, I like Asia for stability, and therefore I'm happy to put more funds to work over here. So that's construct number one. Construct number two that we have seen is that because of the large differential in interest rates between China, mainland China, as well as the US market, a number of investors have started moving funds to Hong Kong to invest in global markets. And that's a theme that we've seen over the last 12 to 18 months. The interest rate differential is not going to go away. Even if US rates do come down, Chinese rates are likely to remain low for an extended period of time. And so we have seen a very strong fund flow into Hong Kong for investments. And people first start with their within your vicinity. So Asia has been a good beneficiary of that. The third construct in the Asian markets more recently is the emergence of what's called a CNH market out of Hong Kong. So CNY is the local currency in China, the renminbi, but CNH is the offshore renminbi with the Y replaced with H for Hong Kong. So that market has started to develop a lot in the last 12 months or so, as the fund flows that I talked about in point number 2 finds its way into that market, as then your currency hedged as well. So some of the issuance that from Chinese issuers that might have otherwise gone into the dollar bond market have now started going into the CNH market. What does this do from an investor perspective? It provides a lot more of opportunity for diversification from a currency point of view. If we were to take a step back into the beginning of this year, we had the first 3 months we'd seen a certain amount of policy uncertainty. In early April, we saw Liberation Day, and one of the outcomes of post-Liberation Day was a concern about whether we would have investors adding more to their US dollar positions. We have seen that, but investors are definitely a lot more interested in diversifying as well. So we've seen a fair amount of investor interest in euros, in Sing dollars, and in Asia, a good amount in Aussie dollars as well. So investors are definitely diversifying where they are putting their money as a result of what happened around Liberation Day and thereafter. Fund flows into US dollars continue to be good, so the US market is continuing to attract money. Foreign money is going to US treasuries, but that diversification play continues to be something which investors are also looking at. So these are some of the key trends that we've observed in the Asian market over the last year.
Thank you, Pramod. Well, that was 2025, and you talked about a number of issues, including various technical factors affecting the market. So on to 2026, if we were to look at the outlook for our market next year, whether you're looking at fundamentals or otherwise, one place you might want to start is looking at the trajectory of US policy rates and also the Treasury yield curve developments in 2026. So as always, there are plenty of moving parts, and arguably we've had as much uncertainties this year than any others. Pramod, can you just share your thoughts on where we're heading with at least those two sort of more fundamental elements of the markets?
That's a great question. So I'm the APAC head of research at CreditSights. We provide investment advice on issuers, for bond issuers, about 1,200 issuers worldwide. I had joined to be the financial sector, be responsible for the financial sector in the APAC region, and then I took over as the overall head of research. And so you have analysts with a lot of sectoral expertise, but at a macro level, we also have a strategy team, and the really important thing that the strategy team does is to decide the points, or to answer the question that you posed to me, David, which is what's the rates trajectory going to be, and how are markets going to behave in, call it, the next 14 months or so. So the house view, where we put out a preliminary outlook for 2026, this was at the end of September. Our final outlook is actually due in a couple of days, but the preliminary outlook is quite simple. So our expectation was for one rate cut this year, and that's already happened. So we're not anticipating another rate cut coming up right now, and that's because as we have seen, the 10-year US Treasury, which was close to 4%, has started moving a little wider with uncertainty in terms of the general environment. So we have expected some kind of volatility when it comes to the 10-year US Treasury to move closer to 4.25% by the end of the year. This is largely predicated on inflation not coming under control, and therefore the Fed being very cautious about actually cutting rates because of inflation not being under control. But the theme that we have seen over the last few months, and we will be getting more data on this in the coming week, but the theme that we have seen is that the jobs market has been really challenged. There's nothing to indicate that that job situation is actually improved. If anything else, anecdotally, there's a lot more of evidence of layoffs on an ongoing basis. So for next year, we anticipate that from inflation, the focus of the Fed will move dramatically jobs because the job scene is going to worsen a lot. We also anticipate that we will see some amount of correction when it comes to equity markets. And one thing, David, is that when it comes to the US, there are estimates that are made that the top 10% of households have been responsible for something like 50 to 60% of consumer spending. So this is the segment of the population that's keeping US growth in a good place from a spending point of view. This top 10% obviously looks at where stock markets are, looks at gold, maybe not Bitcoin because that's just reversed itself, but generally assets under management, they're feeling quite happy with what they're seeing. Now, in case you see some amount of correction, we anticipate that there's going to be caution from this particular segment, and that is going to then, lead to a little bit of a pullback from a GDP point of view. Not dramatically so. We're not saying that there's going to be a crash next year because that's when AI steps in. Just the amount of AI spend that is planned is going to ensure that the worst case scenario is not really going to happen from the US economy. But the job scene is likely to continue to get worse. And so we anticipate 4 rate cuts to come through next year as the Fed tries to ensure that funding costs are low, and that is something that incentivizes industry and the economy to perhaps ensure that there is some more of recruitment. So our expectation is for the 10-year Treasury to then fall to 3.5%, and that's why the House view in general is that it's a sensible idea for investors to get duration, maybe 10 years, 12 years, not super long, not like the 20, 30-year part of the curve, but 10 to 12 years is something that's sensible. We do anticipate that spreads will also widen because with the increased with a little bit of wobbliness in the equity markets, we would and one other thing that David that we're seeing when it comes to U.S. Corporates is that they're getting more shareholder friendly. So you're going to see more shareholder actions, and even if the economy is not looking good, they're going to try to make promises. There's going to be M&A, so there's going to be more supply. In general, we anticipate credit quality in the U.S. is going to decline a little bit. So all of these factors are going to move spreads a little bit wider. But for investors who are looking at an overall return, what are called total return investors, it's going to be a good year because yields are going to drop more than spreads are going to widen. So overall, you're going to make money on bonds, particularly bonds which are in the 10-year kind of category. So that's our call for how life is going to evolve in the US. Now, what does that mean for Asia? In Asia, we are seeing credit quality being actually quite decent. So we're not really anticipating the marginal deterioration in credit quality that we see in the US. But earlier in this, in our discussion, we had talked about how Asia investment grade was about 20 basis points tighter than US investment grade. If US investment grade spreads are going to widen, we do anticipate that Asian investment grade spreads will also widen in sympathy. We don't anticipate that differential will actually become larger. We think it'll stick to 20 basis points. If US IG moves out, Asia IG will move out, and US high yield is likely to move out even further, and so Asia IG will also move out. So it is going to be a spread widening environment next year. So the important thing is keep up in quality and focus on the 10-year part of the curve.
Okay, well, so to recap some of the numbers you mentioned in terms of preliminary forecasts by credit sites, we're expecting the Fed to be done for this year, but up to 4 rate cuts in 2026. Your
Correct.
forecast is for 10-year treasuries to end the year at around 4.25%, but falling to 3.5% by the end of next year. Is that right?
That's correct.
Yeah, and qualitatively, you're expecting risks to pick up, especially on the job side. However, you don't expect the worst case scenario for the US economy because AI spending is likely to replace some of the growth driver that we've seen, particularly on the consumer side that we have seen this year. And you're expecting elsewhere asset markets to be softer. So that would have a weakening effect on consumer sentiment, perhaps.
Perfect. Well summarized. Thank you, David.
Excellent. Well, in terms of the variety of risks that we talked about, I don't think we can really talk about next year without mentioning tariffs. I think you already alluded to that when you mentioned at the start of this webinar, Liberation Day. A lot of commentators are suggesting that the full effects of tariffs implementation and also the sort of rapid changing tariff landscape, the effects haven't fully been reflected in the market yet, and we could well see some of those effects surface in 2026. Now, tariff policies have clearly been a source of market uncertainties for the banking sector, amongst others. Can I just ask you to comment whether there are jurisdictions in Asia Pacific that are better placed than others to absorb the likely impact of tariffs next year? In addition, whether you see markets where there are perhaps more idiosyncratic risks?
No, thanks for the question. By and large, the good news is that after a certain amount of uncertainty, there has been more certainty around tariffs for a lot of different jurisdictions. So preliminary agreements have been reached with Japan, more recently with South Korea. Indonesia and Thailand were actually quite much faster to get some preliminary agreements going than we'd anticipated. ASEAN as a whole has done pretty well. Vietnam continues to grow spectacularly, and from everything that we can see on the ground, it continues to do really well. The one jurisdiction where the tariff situation hasn't really been resolved is India, where there's a pretty high 50% tariff rate right now. And whereas the sectors and the amount of exports that you have to the US are quite concentrated, it tends to be more around the textile sector and gems and jewelry sector that have been affected. There is a knock-on sentiment impact. So that is the challenge for India. There's some amount of press and discussion, both from the India side as well as the US administration, that things are getting closer, that deal should be forthcoming in the not too distant future. But we'll see how that pans out. So in general, after an initial period of a fair amount of uncertainty, the contours of what to expect are coming in place, including with China, where of course tariffs were humongously high and now have found their way back down again. The good news, therefore, is that we're not seeing a dramatic impact as yet on Asian economies. Where we are seeing impact, and impact is something which is more independent of tariffs. So if we were to look at Thailand, for example, we've had a situation where the economy has been weak for a number of years. The political situation is fluid. There are elections that are coming up. And the consumer in Thailand is quite leveraged. Household leverage is very high. And so their ability to borrow more or to provide more loans to consumers again is more challenged. So Thailand has had more structural problems, and the near future again looks quite weak. The second economy where things aren't looking all that good is Indonesia. Again, that is more loss of confidence after President Prabowo came to power last year in October. There was a domestic loss of confidence, and the equity markets fell quite strongly. There are lots of plans on how to reinvent the economy via Dhanantara, which is a new agency that the government has created to help SOE investments. But things have been slow, and the middle class is certainly feeling the effect of that. More recently, we have seen challenges in the Philippines, where concerns about the correct use of government money in climate mitigation infrastructure. Some audits have shown that a lot of the money has been diverted, and so fresh government spending has been curtailed while the situation is sorted out. So there are ripple effects of that as well. So these are all situations which are not really related to tariffs, but idiosyncratic to the individual economies, and that's where we are watching out for as the banking analyst. I do watch very closely in terms of what's happening with the economies and the ripple effect on the banks. The fourth jurisdiction which we're watching out for is Hong Kong. Hong Kong has had a pretty good run more recently with the stock market being up, with renewed confidence in the financial sector, with more employment in the security side of the the economy, which is fantastic. But the segment of the economy which is more challenged is the property sector. We are more concerned about um, property loans to a small and medium-sized landlords. These are collateralized, but it does look like the Hong Kong property market is continuing to see challenges. It's unclear whether if a bank does take a property back, whether they would actually be able to sell it at a sensible valuation. And so we do think that the banking sector is likely to get hit at some point of time, or some of the banks at least, on their property sector loans. So these are the different segments. These are the different countries that we're looking at. The good news is that the tariff impact has been less and more sorted out, but the idiosyncratic factors in different economies is causing a problem.
Yeah, so the good news, according to you, is that even though tariffs continue to be a source of uncertainty, we actually have less uncertainty than we were perhaps back in April, because some of the agreements, trade agreements, have been reached or being reached. However, the not so good news is some economies in the region are affected by factors other than the tariff. So in your views, can't blame tariffs for everything. You mentioned Thailand, Indonesia, and the Philippines. And I was thinking, oh, what about developed markets in APAC? And then you mentioned Hong Kong. And I totally agree. I saw an article today that talked exactly that about valuations, particularly in the CRE space, being very similar to some of the valuations by independent valuers, not that different to what they were back in, say, 2018. However, the market seemed to be showing something different. So plenty to watch out for. We're now half an hour into our webinar. I just want to reiterate, please feel encouraged to use the Q&A button at the bottom of your screen to post any questions for Pramod. One more question, Pramod, and maybe slightly different to what we've been discussing so far. I'm fully aware that credit sites throughout your team, you have lots of frequent investor engagements, and I think the audience probably quite interested if you can share with us what investors lately, what the key concerns have been, what kind of questions typically come up in your discussions in the last few months.
Thanks, David. So the good news for Asia, I think, is that they're relatively comfortable about what's happening in Asia. We outside of New World Development, which is a situation that was evolving. Outside of New World Development, which is a situation that was evolving in Hong Kong, which is now largely sorted itself out. In the recent past, fortunately, Asian markets have been affected by any particular type of credit. But if you were to look more worldwide, and a lot of Asian investors do have investments in both the US market as well as the European markets, we have started getting questions more along the lines of concerns around AI, concerns around private credit, concerns around governments and government spending in Europe. So just taking these one by one and starting with AI. So the question is around the circularity in the AI space of a lot of contracts being made from one party to another, and then long-term contracts coming back from that party to the first party. So is this something which is just meant to ensure that valuations are going to go up? Are we going to be left with a scene where after a lot of spending, a lot of it has been incorrectly spent because there's a lot of tech spend that's happening on computing power being developed right now, and the data centers are a lot of data centers that are coming up. Do they have enough electricity? Are there too many data centers that are coming up? And that's outside of the stock market valuations of AI stocks. So that's, I think the investors are trying to work their way through how this is evolving. What we can say with certainty is that tech firms and there five of them who are in this particular space. Amazon, I think we'll also bring into the category of tech firm because of their cloud business. So we got Amazon, Apple, Alphabet. We also have Oracle more recently, and Meta. They are spending massively on technology, and these were companies that had really high margins, a fantastic cash flow. 2024 capex for all of them combined was something like 250 billion. This year, we anticipate it is going to increase to 450 billion. And in 2026, it's going to be 600 billion. These are just five firms we're talking about, and 600 billion of capex. So the model is changing quite dramatically. For some of these firms, they're spending 50% of their sales revenue on capex, which is absolutely unheard of in this particular space. But the reason that they're doing so is that it is very likely to be, if not necessarily a winner take all, but a winner is going to get a really good share of this. And so we won't know who's going to be a winner for some period of time. So the concern from investors is, how is this going to end in tears at some point of time? With the large firms, with these large technology firms, we don't think so. They've all got fantastic balance sheets, but the concerns go beyond them into the data centers part of the business. For the next couple of years, at least, we think that things are getting built up in a sensible kind of way. The long term beyond that is slightly more tricky. The good news is that power generation for all of the data centers, for all of the capex that all of the hyperscalers are putting into place, that is also coming on board in a sensible kind of way. So some parts of it are okay. We don't have very serious concerns about these factors. But once you see the numbers, there automatically tends to be a little bit of a concern about where is this all going. One other factor to think about is that OpenAI, for example, has estimated revenues of 20 to 25 billion. They have capex plans of 1.4 trillion. We're talking about very large numbers over here. But what they have committed to is 100 billion of capex, and more to be brought online as long as their plans actually work out. So sometimes the numbers can be pretty staggering, but it is meant to happen in tranches. One of the other reasons why we might see a little bit of widening on spreads is because of supply. In the bond markets, we have seen some pretty large issuances coming recently from Oracle, from Alphabet, from Amazon. That's likely to continue next year. Technology supply will be very large in the bond markets, in the US bond markets, and to a certain extent in Europe as well, as the issuers try to diversify. So that's what we're seeing in the AI space. It's not something which is a super concern to us at the moment. Private credit is a bigger concern, and private credit is a bigger concern because it's been a sector that has taken a lot of funding from institutional investors and more recently from high net worth individuals. Where a lot of funding is available, what we have seen is that standards automatically start to loosen in terms of deployment of those funds because you're in competition and you need to deploy. We have seen a couple of instances of things of situations blowing up with Tricolor and First Brands, and there are more that are coming every couple of weeks. So it does appear that that private credit is likely to see some number of challenges. The second factor is that whereas private credit, the funds that they used to raise used to have very good gating, which meant that you put in your money, you can get it out, but you have to give a fair amount of notice. So if I give notice today to a private credit provider, I would then be put in a line and then I'd get my money maybe 6, 7 months down the road. So there was gating to ensure that if a lot of investors wanted to exit, um, there was a phased way in which assets could be liquidated if required to give back their money. What we are now seeing, David, is that a lot of providers of private credit to keep to incentivize people to join are loosening that requirement, are making liquidity a kind of like available as and when you want it, which means that in case there's an issue down the line, we might see fire sales happening and investors hitting problems. So it is a sector that personally I'm a little wary about, and it is likely to hit some kind of trouble in the not too distant future. The third sector that segment that we do get a lot of questions on is around Europe and governance. Not necessarily governance. I misspoke, but more governments. If you look at France, for example, the political situation isn't great. The prime minister, there have been quite a few prime ministers rolling, and a budget is still yet to be decided on. So that situation doesn't look to be very good, very strong, and that has repercussions for how much of debt issuance comes out of France, as well as more challenging conditions for the banks and corporates in that particular economy. In Germany, there have been a lot of hopes because a bill has been passed which has promised a lot of spending on infrastructure. Europe as a whole is going to be increasing its defense spending, and Germany is going to be leading that particular effort. But again, the implementation has been really slow. So hopefully the German government is able to get its act together in the near future, because that process has not really kicked off, and so the fund flow elements of things and how it works its way through the economy and gives a boost to Germany and of course to Europe. That's something that investors are now getting a little bit impatient about. So these are the three, shall we say, broad areas where we have received questions more recently, David.
Thank you, Pramod. Before we move on to the Q&A, I just want to pick up on your comments regarding private credit. Now, we've had some fairly high-profile industry professionals essentially arguing on both sides of risks. We've got one side making the analogies of cockroaches in kitchens, and then there are others who basically say, no, it's fine. It's part of a development of any market, and we have sufficient safeguards. So where would you stand on that sort of argument as to whether this is part and parcel of a relatively new product hitting investors, or whether you do agree that perhaps there are practices with some of the borrowers that are not perhaps up to the standard that the rest of the market expects?
So what I talked about earlier, David, is a pretty broad brush, and it's good to challenge that particular point because in every market, uh, whether it's banks or insurers or fund managers or now private credit, you will have savvier, sensible players and less savvy, less sensible players. And some of the less savvy, less sensible players maybe get caught out by situations as they arise because the level of due diligence that they've done is perhaps not up to what investors would expect them to be. And and um, and so as situations develop, then after that, they find that their investments have gone into the wrong into the wrong space. So I would say that it's fair to say that there are um, people who know what they're doing, uh, but it appears that there are a fair number of people who don't know what they're doing either. One company that I think has come out uh, looking better out of all of this is Apollo. Um, Apollo was actually shorting First Brand stock, I believe, because they could see what was happening, and they decided that they would take a position on the other side. So worked out very well for them. Not didn't work out that well for some other folks in the private credit market. So it does. Um, it does come down to the point that that there would be some players who really know what they're doing, and even in a space which is challenged, would be able to navigate their way to maximize some return out of the situations that develop.
Thank you very much, Parul. We've got some questions filtering in from the audience. Shall we address some of these? I think
Wonderful,
we have
thank you.
around 15 minutes left, so I think this might be a good time to pivot. One of the questions was about Asian corporates relating to tariffs. And in your view, are you seeing Asian corporates absorbing the impact of tariffs right now, or do you see, credit metrics being hit anytime soon?
Great question. So not entirely. We're not really seeing that completely in the numbers. There is a little bit of caution around Japanese automakers and how much they have been absorbing. I must admit that I'm not completely on top of the facts when it comes to the Japanese automakers, but that's a segment there where people have said that there is an impact. But outside of that, we're not really seeing it amongst the credits that we're covering. For one important reason, which is that a lot of the credits that we cover, even if they're really large and important, tend to be very domestic focused and not necessarily in the exports space. It's broadly acknowledged at the moment that tariff pass through has not happened to the consumer. And this is could be because margins are getting swallowed to a certain extent, or there was a lot of front loading, or for many sectors, the uh, the uh, the the margins have been kind of broken down to a certain extent between some that is passed on, some that is with the distributors, that has been passed on to the distributors, and some has been absorbed by the company itself. So, but at the end of the day, for the consumer, that it hasn't really come through all that much. But to get back to your question on the companies themselves, we are not really seeing very much of an impact in Asia as yet from a tariff perspective.
Okay. Sticking with impact to corporates in this part of the region, but maybe sort of moving towards ESG concerns. Have you seen any impact from climate-related risks or any sort of transition policies on credit trends in APAC?
So, unlike what we are seeing in the US, where there has been a wholesale movement back on a lot of ESG policies, if you see the reality of climate change in Asia, we are seeing that governments are continuing to direct policy towards um, ensuring that we have sensible transition, and more importantly, both companies as well as ordinary citizens are also keen to see that that happens. So this is something that we are seeing from across pretty much all markets. So we wouldn't really say that there has been any significant change in the pace with which ESG or climate transition is in the process of getting rolled out. There are challenges everywhere. A lot of the promises that have been made at forums such as COP are unlikely to be met, but those are long-standing challenges, and some of it comes down to um, technology that needs to be developed that will allow the kind of emission numbers that we are talking about to be met, and that technology is still work in progress. To get there, you need an intermediate step before you get to that unproven technology to improve your output and reduce emissions from where it was, call it a few years earlier. So there's an intermediate step, and the capex involved in that, and the amount of time that it's going to take for it to be profitable is perhaps longer than what it will then what it would involve to have that final step brought forward. So long and short is that it's a journey. It's a journey that's being undertaken in the APAC region. We're not seeing anyone stepping away from prior commitments, and they're going to try to continue to build up on those particular commitments.
Thank you. I've got a couple of questions coming through relating to the fringes of the sort of just outside the traditional core banking sectors in APAC. Maybe I'll take these one by one. So digital banks have been introduced gradually in various jurisdictions over the last 5 to 10 years. Some are becoming more mainstream, but are you actually seeing any Asian banking systems where the traditional banks are losing deposit share to digital bank entrants? That's sort of meaningful enough to worry bondholders?
Not really. In Asia, the incumbent banks have recognize the potential challenges that could come in from these digital banks, and therefore have tried to convert themselves into digital banks as best as possible. And therefore, the product differentiation versus that a digital bank offers versus a traditional bank, it's very minimal. Maybe it's easier to open an account. Maybe there are some early incentives that digital banks provide, but otherwise the convenience of a conventional bank and their interface, their digital interface is significantly superior. So we haven't really seen that kind of effect anywhere in Asia, David.
Yeah, no, I concur with what you just said. When I speak to people from different jurisdictions, certainly as a bank customer, as a depositor, they really don't see too much difference in terms of the user interface, the technology. I think all banks have spent quite a bit of capex on that front to be relevant. I guess perhaps where there might be a small difference is some digital banks may be using higher incentives to attract new customers, and maybe on the sort of borrowing side, certain markets probably target those who are less serviced by traditional banks. One question that's maybe related to private credit, not directly, is people have obviously voiced concerns about the proliferation of private credits to certain parts of the investor segment. The one member of the audience is asking about whether you're spotting any potential issues in the traditional NBFI space that might cause stress in the market and might surprise investors.
At least in Asia, we're not really seeing that. If we cover a fair number of non-bank financial institutions who are lenders across all types of spaces, whether it's retail and autos and gold-related loans in India, or it's against motorcycles in Thailand, or aircraft and ship lessors in China. In all of these spaces, we're not really seeing any kind of contagion effect. Um, what we what we are seeing is very much a function of the business model that each one of these is involved with, and some of them are working out really well, and others are facing challenges. But nothing that is that's causing any type of system type of concern or related it to any way in related in any way to private credit. So in Asia, at least, we're not seeing it. For other jurisdictions, I'm afraid, David, I won't really be able to comment. I'm not
Yeah.
that familiar with the, how exactly the Venn diagram works and the intersection.
Okay, so as far as you're concerned, probably at this stage anyway, no more than expected business risks, various sectors, to nothing particular systemic that you are seeing right now. I think we've got time for one more question. And the question is if you are seeing where you are seeing the biggest dislocation in Asian financials between sort of equity and credit.
Oh, that's an interesting one. I wouldn't really say that I'm super aware of where equity markets are with a lot of the names that we cover. We do tend to look at price to book ratios for some of the names, and directionally where are they headed. But valuations wise are things particularly rich in certain areas, or otherwise I think that's perhaps a little bit more of a challenge. Taking a step back, are there any I think that actually we would assume that there's a fair amount of a common view between how equity investors and credit investors are looking at certain names, because it tends to be more the macro conditions um, that are involved with a particular sector that cause issues. So um, for example, I would anticipate that Thailand there's a little bit more of constraints. Indonesia, there's a little bit more of constraints. Philippines, there may be some constraints coming in as well. So that we see that from the credit space. I'd be very surprised if the equity markets were also not in the same space. So I think in case there's a dislocation, that means that one market is like particularly bullish and the other one is bearish. To the best of my knowledge, I'm not really seeing that in the names that we cover. As a slight aside, there is a name that has lost 10% of its market cap in recent days, and that's Commonwealth Bank of Australia. But they used to trade at particularly high price to book ratio, perhaps amongst the highest in Asia. And they came out with a trading statement that said that net interest margins were coming a little bit under pressure. They were the last to come out. The other banks have mostly managed to protect their NIM, so they lost about 10% of their market cap last week. I haven't checked to see whether there's been a little bit of a recovery over there, but that again was a very well regarded name, correctly so, losing some of its high valuation because of a slightly lower net interest margin outlook. But that's the only recent equity market correction that I would say that I'm aware of, but it's because of stratospheric valuations.
Great, thank you, Pramod. We don't have any more audience questions, so perhaps if I could just wrap up by first doing a recap. So I know sort of credit analysts have always been accused of being sort of leaning more towards the negative side, looking at the risks for obvious reasons. So looking into 2026, we're obviously not expecting the worst case scenario. However, where there might be softer numbers, it could be in the US equity space, it could be the job space. Even though we are expecting policy rates to come down by a percentage point, we are expecting credit spreads for a variety of reasons to widen slightly. And outside of tariffs, you named several emerging markets where there are idiosyncratic risks, and not forgetting Hong Kong with its property sector also likely to see a continuation of softness. So I guess that sums up your views for 2026. There are obviously some concerns with the very high, or at least compared to traditional ratios, very high CapEx expense versus revenue in the AI space. There's some concerns from market participants on private credit and the standards. But otherwise, sort of in terms of systemic risks, it's at this point anyway, there are no obvious candidates. So Pramod, if you don't have any closing thoughts, you may have. I would like to thank the audience and also thank you for your time today and joining us. Lastly, I just want to mention there are going to be more upcoming webinars on everything credit. So please stay tuned to the Global Institute of Credit Professionals website, www.gicp.org, for future events. Pramod, if you are happy for me to close the session, I will end right here.
Thanks for having me, David.
Thank you everyone for participating. Goodbye now.